Now let's start our class. Good afternoon, everyone. I need anyone to confirm that you can hear me before I proceed.
Good afternoon, sir. We can hear you.
Okay, good. Good. You're welcome again to another class on strategic business reporting. Firstly, we need to finish up the remaining part of IFRS 16 on leases. We could not get to this part last week, but at least on Wednesday, we were able to achieve a substantial part of what we're supposed to do. Still on leases, remember that there is a lessee and there is a lessor in every lease transaction. The lessee is required to recognize right of use assets and lease liability, and for the two, he would recognize the present value of the unpaid lease rentals. However, for right of use assets, we would then need to add the amount paid at the commencement date, initial direct cost, and decommissioning cost. For the lease liability, at the end of each year, we need to increase that lease liability with interest and then decrease it with lease rentals. And this order can change, if the lease rental is paid in advance. For the right of use asset, at the end of the year, you're expected to depreciate the asset over its lease term. For the lessor, we mentioned that the lessor needs to identify the class of leases entering into. It needs to identify whether is engaged in a finance lease or an operating lease. After he has identified which lease he has entered into, then that will determine how he's going to treat this item. We said for him to know whether he has entered into a finance lease, there are indicators of finance lease, because for finance lease, it means that the lessor has transferred substantial risk and reward. And in accounting for a finance lease, the lessor will need to derecognize the asset from his books, and also he will then recognize a net investment in the lease. And the net investment in the lease is recognized by adding the present value of unpaid lease rental and the present value of unguaranteed residual value together. And at the end of the year, we'll increase this net investment in the lease with interest and decrease it with lease rentals. For a manufacturer or dealer lessor, we said that you will need to also recognize a gross profit in addition to the net investment in the lease by comparing sales with cost of sales. For operating leases, we said the rent received or receivable would be recognized on a straight line basis over the lease time. We solved questions on Wednesday on all these principles. So we did quite a lot. Now, the last part of leases is sales and leaseback. This is very similar to repurchase arrangement, just that this one is now very specific. We now know that, okay, we are leasing back. So two things are clear here. There is a sales and the seller wants to lease back the asset. Fine, it's okay. Now, The accounting issue here that we need to resolve is that when you know that you still need an asset, why did you sell it? Why did you sell the asset? Why are you going through this route? You still need it. Why did you sell it? So, majorly, what we need to establish is that we need to establish whether this original sales is actually a sale or it is a financing arrangement. That's what we need to establish. Why did you sell? So we need to see whether is it actually a sale. If it is actually a sale, then fine. Or is it that he just gave up his assets as collateral just so that he can collect money? So we need to establish whether it is a financing arrangement. The examiner in the exam will not test you on this under leases, IFRS 16. The examiner will tell you whether it is a sale or whether it is not a sale. They would make it clear for you. It will be very clear. If they want to test all of this, then they will be testing repurchase agreements that we did in IFRS 15. Here, where the transaction is actually a sale, then it becomes straightforward. In such case, the amount received will be treated as a revenue. It is a revenue because it is actually a sale. So the amount received from the original sale, you will treat it as a normal, as a revenue in your books. Now, the assets that was leased back, the asset that was leased back will then be recognized the asset that was leased back will then be recognized in line with how a lessee recognizes a lease transaction. That is, it will recognize a lease liability and a right of use assets. It will recognize a lease liability and a right of use asset. Just like we have learned earlier on. However, since we are saying it is a sale, there are some further checks we need to do. If it qualifies as a sale from the transaction, we see that this is a sale. There are some further checks we need to do. So the checks is that we expect that the consideration received should be equal to the fair value of the assets at the date of the sale. So what we are saying here is this. Okay, fine. We said the transaction is a sale, and we have recognized the consideration received or expected. Consideration received or consideration expected. The money we're expecting. We recognize it as a revenue because we said it's a sale. Fine. And remember that we leased back the assets. We said, okay, fine. This asset that we leased back, then the lessee, because the guy becomes a lessee now, since he had leased back the asset. So you will recognize that asset in line with how a lessee recognizes a lease transaction. So that is, you will recognize a lease liability and also recognizes a right of use asset. Additionally, we expect that the consideration he has received, we expect it to be equal to the fair value of the asset. That's our expectation. In the exam, you might find out that they might not be the same. So if the consideration received is higher than the fair value of the assets, the difference will be treated as you are going to see that as an additional loan.
I hear you, sir.
I can hear you, sir.
Okay, good.
I can
So
hear
as
you,
I,
sir.
okay, good. So as I was saying, we need to we expect that the consideration received should be equal to the fair value of this asset at the date of sale. If the consideration received is higher than the fair value of this asset, we are going to treat the difference as a loan, even though yes, you have sold, fine. But if you remember under IFRS 13 that I told you that fair value is the amount that is received to sell an asset. So the consideration received should be the fair value. So why is the consideration received not the same as the fair value? Why is it not the same as the fair value? So if it is higher, if you have received much more, that means there is nothing you can tell us. That buyer is giving you that extra money as a loan. That additional money he has given. Why will he give you higher than the fair value, which is supposed to be the selling price? He's now giving you much more. We are going to treat it as an additional loan. That is how you're going to treat it. And you see, the thing is now that since it's a lease back, since this guy has leased back the assets, remember that he will need to be paying rent, either monthly or annually. You see, this rent now that he is now paying, it will now be, the repayment would also include the repayment of the loan. So the major challenge here for you is to separate the one that is loan from the one that is lease liability. That's the major one. So we need to solve a question that will show how to do that separation. That, okay, this one is the loan, this one is the lease. Because the repayment, the lease rental will be above market rates. The lease rental will be higher because they will have incorporated repayments of the additional loan inside, aside from the rent, aside from the lease rental is paying. So we need to do that separation. Additionally, if it's the reverse, where the consideration received is lower than the fair value of the assets, the difference will be treated. Let me give you an opportunity. Who can tell me what would the difference be here? What do you think the difference should be? Okay, nobody. So the
I would say
difference,
revaluation surplus. I don't know.
we didn't hear you, Chinaya. The difference is going to be treated as an advance payment of the lease or amounts paid at the commencement date, or you can call it prepayment. Prepayment.
It's
Because when
very
we
unconventional.
collect, say it again, Manuel.
Oh, sorry, I didn't know I was on mute. I was saying this is very unconventional.
Yeah. I mean, you're learning something new. So, if the consideration received is lower than the fair value of the assets, right? If the consideration received is lower than the fair value of the asset, it means that you decided, you sold an asset, you know that the selling price of this asset is 10 naira, and you decided to collect 7 naira. Why would you do that? So, see, what we are trying to do is we are trying to cover loopholes in accounting here. Why would anybody receive lower? So, in order to link it up with the fact that he's leasing back, so we are trying to patch everything up under that lease arrangement. So, for us, we believe that what you're doing, for you to have received lower, that means you have already paid part of the lease rentals in such a way that the lease rental payments, the subsequent lease rentals payments will be below market rates. So that means they will not help you reduce your lease rental that you want to pay later, just because you have accepted to receive a lower amount. You see, this prepayment will be treated as an addition to the right of use assets. If you remember, that's how we usually treat amounts paid at the commencement date. We usually add it to the ROU. If you remember, right of use asset is PV of unpaid lease rental plus amount paid at the commencement date plus initial direct cost, like that. And that's exactly how we're going to treat this guy at the same time. So, and the rightful owner is, so farmer is asking that who is the owner of the asset? He has sold now. We are saying this is actually a sale. So a new person has bought the asset. We are just leasing it back. So this is everything. This is how you treat it. So let me just recap it again for you. So you sold and leased back. IFRS 15 says, yes, it qualifies as a sale. We look at it, we say, okay, you have transferred control. Fine. So the money you received from the sale, we said is revenue. Now, no issue. The issue is the fact that you have leased it back now. automatically you are a lessee. So you're expected to recognize this in line with how a lessee will recognize the lease transaction. So the lessee will recognize lease liability and right of use assets. This should not be also difficult for you. Now, we now need to check whether the consideration received, we expect consideration that you received in this transaction should be equal to the fair value. So this is where we want to cover loopholes. Where consideration received is not equal to fair value. We want to use this to cover all possible loopholes they might want to explore in this type of transaction. So the first we check is that if the money you received from the sale is higher than the fair value, we treat the difference as an additional loan. Okay? In fact, the lease renter in this case, the lease rentals or the subsequent lease rentals will be higher than the market rates because it will factor in the loan repayment also. So we need to separate the lease liability and the loan. We need to separate it. So you have to be very careful. The lease rentals will be, if the consideration received is higher than the fair value, definitely the lease rentals that this lessee will be paying it will be higher than the market rate. So if you just do PV of lease rentals to get your lease liability, you'll be wrong. You have to remove that loan from that amount you get because they will give you the loan amount. The balance will be the lease liability. I will show you a question that actually settles this. So where the consideration received is higher, that's a loan. And we'll need to separate that loan from the lease liability. Otherwise, it will affect some of your calculations. But if the consideration received is lower, then we believe that for you to accept a lower consideration, we are going to treat the difference as a prepayment. And prepayment are usually added to the right of use asset. So we are just covering any lapses we can find and adjusting it on the lease transaction. We are adjusting it on the lease transaction. So for this now, the lease liability will be measured as you have learned under lessee accounting. There won't be any difference, just the same way I've taught you, except where you have to remove loan from it, where consideration received is higher than the fair value. But the right of use asset now, we have to be very careful here. The right of use assets will be measured as a proportion of its previous carrying amount. As a proportion of its previous carrying amount. So, because this asset was your asset before, you add it in your books, but you said you sold it, you recognize the asset and all of that. You now leased it back. Now, when you leased it back, you are going to recognize right of use asset. So we want to avoid a scenario where the value you recognize as right of use assets will now be higher than the previous carrying amount. What you add, the value you add it in your books before. We want to avoid that in every possible way. because we believe that that would be creative accounting. It should not be higher than it, just because you entered into sales and leaseback. So the standard requires that you measure the right of use asset at the proportion of its previous carrying amount. So that means the right of use asset would be measured like this. It would be, we'll say, the previous carrying amount times the discounted lease payment or lease rentals divided by the fair value of the assets. So this is calculated as below. So this is how you recognize the right of use asset. Now, additionally, when an asset is sold, since this is a sale, when an asset is sold, an entity or the entity will make a profit or loss on sale. So the profit on sale, the profit or loss on sale profit or loss on sales is calculated by comparing the fair value of the assets with the book value of the assets. However, this profit calculated above cannot be entirely recognized to profit or loss because the asset was leased back. So since the asset was leased back, then there is this profit on sale or this gain on sale. Let me call it gain on sale or gain on disposal. It's better like as gain on disposal. You cannot recognize everything as income in your P&L because you leased back the assets, because you are still using the assets. So the portion that cannot be recognized, the portion of the gain that cannot be recognized as income is derived as below. So you get that total gain computed above. This one, this gain that we computed here, this gain that we computed here, this gain on disposal, you do multiply by the discounted lease payments divided by fair value of the asset. So we call this is called gain on rights retained. So the balance will represent the gain that can be recognized in profit or loss as an income, and which is the total gain minus the gain on rights retained. Okay, now I've finished. So there are like 3 levels of things you need to know here. And even though ICAN has really never asked this sales and lease back, I don't joke with it every diet because they can ask it anytime, which is why I always make sure we look at it properly. So again, you sold an asset and you leased it back. We said the accounting issue here is we want to establish whether the original sale is actually a sale or it's a financing arrangement. So if the examiner tells you that it's a sale or there is a pointer that shows you that control has been transferred, then you can treat it as a revenue, or if it's not an item that you deal with as your day-to-day operation, or you derecognize the assets from the books. Just remove the asset from your books, then you get a gain or loss on sale. Now, you also recognize lease liability and right of use since you are leasing it back. We then check the consideration received with the fair value. If the consideration is higher, the difference is additional loan, which you separate from the lease liability. If it is lower, the difference is a prepayment or amount paid at commencement date, which you are going to add to the right of use asset. The lease liability will be measured as you have learned under lessee accounting, but the right of use assets will be measured as a proportion of its previous carrying amount, which is calculated as previous carrying amount times discounted lease payments all upon fair value. So when an asset is sold, usually it will be a profit or loss on sale, which is computed as this, fair value minus carrying amount. Now, we cannot recognize this entire profit to P&L as income because the asset was leased back. So you cannot say that you have earned the entire income or gain on that sale because you leased back the assets. So the portion of the assets that we believe you have leased back, which is the discounted payment you have to pay all upon the fair value, times the total gain, we call that gain on right retained. This portion of the total gain should not be recognized to P&L. So the balance is what we recognize, which is the total gain minus gain on right retained. So the above results is known as gain on rights transferred. Okay, I think we have learned a lot of theory. I think it makes sense to solve questions so that this can make a little sense to us. Okay, let's hear another person's voice. Is Ifua here? He's not in class today. All right. Who is in a position to read? Oh, he's in class, but I'm not sure he's with us. Is there any other person that is willing to read for us? Okay, it's better I read myself because I can see people have a lot of time at your disposal to waste. I don't. So question, it says on 1st April 2002, Networks bought an injection molding machine for 600,000. The carrying amount of the machine as at 31st March 2003 was 500,000. On 1st April 2003, Networks sold it to Wise for 740,000, its fair value. Networks immediately leased the machine back for 5 years. The remainder of its useful life at 160,000 per annum, payable in arrears. The PV of annual lease rentals is 700,000, and the transaction satisfy IFRS 15 criteria to be recognized as a sale. What gain should net worth recognize for the year ended 31st March 2004 as a result of the sale and lease back? Okay, so this one just wants us to calculate gain on the sale. So from here now, on 1st April 2002, Networth bought a machine for 600,000 in 2002. The carrying amount as at the end of that year is 500,000. At the end of the new year, which is 1st April, he now sold it to Wise for 740. But Networth leased it back immediately for 5 years and will be paying a rent of 160 per annum. The PV of the lease rental is 700. Okay, fine. So what gain can you recognize? First, we will get our total gain on disposal, which is the fair value of these assets minus carrying amount of these assets. And the fair value of these assets, how much did they sell the assets? He sold it for 740. So we have 740. How was the book value of these assets? That's 500. The difference is the total gain. Now, since he leased this asset back, he cannot recognize this total gain to P&L. We need to take away gain on rights retained, which is the total gain times the discounted lease payments divided by fair value. The total gain is 240. What's the discounted lease payments? 700. What the fair value of these assets? 740. If I punch my calculator, this will give me 700 divided by 740 times 240,000. This will give me 227,027. Then the gain that I actually recognize to P&L is the gain on rights transferred, which is total gain minus gain on rights retained. The total gain is 240. The gain on right retained is 227,027. And the gain on right retained is 12,972. Well, let me approximate it, 73. And this is the gain that will be recognized to profit or loss. The second question, this one was adapted from the standard directly. This one says that net worth sells building to Risk PLC for 800,000 cash. The carrying amount of the building prior to the sale was 600,000. Net worth arranges to lease the building back for 5 years at 120,000 per annum, payable in arrears. The remaining useful life of the asset is 15 years. At the date of sale, the fair value of the building was 750, and the interest rate implicit in the lease is 4%. The cumulative present value of 1 year for 1 naira for 5 years is 4.452. This is the discounting factor. This is the discount factor. The transaction satisfy performance obligation in IFRS 15, so it will be accounted over as a sale and leaseback. Okay. So this one is a sale from this last paragraph. They are saying it is a sale. So since they have sold it, net worth will derecognize the assets from its books. You would recognize the asset from its books. And secondly, you will recognize net worth will recognize a lease liability and a right of use assets, and you will measure it. And when he recognizes this, then he needs to do some checks, like I told you, by comparing the consideration received with the fair value of the assets. So that is very important because that will help us update each of these two. So from this question, the consideration received, which is 800,000, is higher than the fair value of the assets, which is 750,000. This 750 here. The difference of 50,000 will be treated as a loan. Let me call it additional loan. So let's do the breakdown. First, the lease liability we're given the PV. Are we given the PV of lease rentals? No, but we can calculate the PV of lease rentals. They told us that he will pay annual rent of 120,000 per annum. So we need to discount that to present value using annuity factor. You don't need to do any formula. They already gave us the annuity factor of 4.452. A lot of people might not even know that this is the annuity factor, but they have told us that the cumulative PV of 1 naira in 5 years' time is 4.452. That's the annuity factor. So if you multiply this by 4.452, that will give us, I do 4.452 times 120,000. That will give me 534,240. Now, what I was explaining to you before, since the consideration received is higher, that means this 120,000 will include repayment of loan. This 120,000 is not just lease rentals. It includes a repayment of this loan. So it's above market rate. So we need to remove. So the PV of lease rental should be adjusted for the loan. So the PV of lease rental then becomes this 534,240 minus the loan element of it, which is 50,000. So we'll be left with, if I deduct 50,000 from this, that means the actual PV of lease rental is 484,240. That's what I was saying, that whatever PV of lease rentals you get, you need to separate the loan element from it. Otherwise, it will affect your calculation. And one of the calculations it will affect is my right of use assets. And my right of use asset, we said we will calculate it as the previous carrying amount times the PV of lease rental or discounted lease payments divided by the fair value of the assets. The previous carrying amount of this asset was 600,000. It told us the carrying amount in before sale is 600,000. So this 600,000. The discounted lease payment is this 484. A lot of people will use this, but this one is, there is the loan element there. So it will be 484,240 divided by the fair value of these assets. And the fair value of these assets is 750,000. 750,000. So if I punch my calculator, this 484, I divide it by 750,000, then I multiply it by 600,000. It gives me 387,392. That's my right of use assets. Then of course, you can then depreciate this. You can do your depreciation per annum, which is the 387,392 divided by the lease term. And what's the lease term? 5 years divided by 5. If I divide this by 5, give me 77,478. Finally, I will then recognize the gain. The total gain is the fair value minus carrying amount. And the fair value is 750,000. The carrying amount is 600,000. My total gain, therefore, is 150,000. Then I will derive my gain on rights retained. which is the total gain times discounted lease payments all upon fair value. The total gain is 150,000. The discounted lease payment is this 484,240. All upon fair value, which is 750,000. So with this, my gain on right retained is 96,848. And the gain you put to your P&L is the gain on rights transferred, which is my total gain minus gain on rights retained. My total gain is 150,000. My gain on right retained is 96,848. And that gives me how much? 53,152. So that's all this is happening on the date that is said is sold. If I want to put this transaction for you in like a journal, first, you received 800,000 money. So money came in, 800,000. He sold the assets. He will remove that from his books. The 600,000 sale. Then he will recognize right of use assets. And lease liability. And we separated the lease liability from the loan. How much was the right of use asset that we computed? That's this 387,392. That's the debit, of course. The lease liability will be a liability credit. And yeah, so that's which will be the balance here after removing the loan. That is 484. Then the loan we said is 50,000. And don't forget, after when we did all of this, we made a gain on rights transferred. How much was the gain? Said is 53,152. This one. All right, sum this together. That is 800,000 plus 387,392. That is 1187,392. If I sum this 600,000 plus 484,240 plus 50,000 plus 53,152, that also gives us 1187,392. So now that's what we're doing. All these are just happening at the date of sale. Removing the asset from the books, recognizing lease liability and right of use, checking the consideration received against the fair value, treating the difference as a loan. This teaches you everything that needs to be known. So at the end of the year, this depreciation we computed now, this will be recognized to profit or loss, P&L. And this lease liability, this 487,240, you know that you're going to unwind the discount. You're going to increase it with interest, and also you decrease the lease rentals. But when you're doing that, because the lease rental you decrease already includes the loan itself. Already, so is this you're going to use to determine that. So you want to finish everything for the lease liability now. At the end of each year. So which year is this now? This is 2000 and oh, they didn't even put period. No problem. So at the end of the year, let's say year one. So the balance brought forward for the liability is this 584,240. Then you are going to add finance costs at which rate now? They give us the discount rate. They give us 4%. At 4%. So 4% times 534,240. That would be 21,370. And I will deduct the lease rentals, which is 120,000. The balance will be this plus 534,240 minus 120,000 lease rentals. This will be 435,609. And in year two, we have 435,609. We'll multiply that by 4%. That will give us 17,424. Remove the lease rentals. That gives us 333,033. So let me stop in here too. So if you're asked to prepare a statement of profit or loss at the end of year one, I will have my depreciation. I computed my depreciation up here as 77,478. And I will have my finance costs in year one. I computed it here as 21,270. Also, my statement of financial position for year one, under my non-current assets, I will have my right of use assets. The cost of the right of use assets that we determined was 387,392. You deduct accumulated depreciation. which up there was 77,478.4. So that means our carrying amount is 387,392 minus 77,478.4. That's 309,913.6. Additionally, for the lease liability, we'll recognize a portion as non-current liability and another portion as current liability. And since we have already done 2 years, our lease liability in year 1 is 435,609. The difference between it and the second year balance would represent what we will pay in year 2. And that will be the current portion. So if we do 435,609 minus 333,033, that gives me 102,576. And the balance, if you take away this 102,576 from this amount, it will definitely give you this 333,033. And that will be my non-current liability. And I've fully solved this question, even beyond what I'm expected to do. So I would ask you to solve this question is similar to what I've solved so far. And also do this one also as assignment. So this particular one is where the lease rentals is lower. Yeah, it's below market rates, where the consideration received is lower than the fair value of the assets. So you can try your hands on those two. And that is all for IFRS 16. I think we have tried. It took us almost, yeah, like 3 classes, like 2.5 classes. Now, let's start another topic. Okay. So, I want us to finish up IFRS 8 on operating segments and also IAS 34 on interim financial reports. Then we know that we have finished almost all the standards that we need to finish up. Then before we then commence group accounts. So mostly we should start group accounts on Saturday next week. After we are already done with this one and IAS 34. So IFRS 8 operating segment. So is very common to find organizations that operate in different geographical areas or organizations that sell different range of products or services. Such organization needs to provide, they need to give their users segment information. And this segment information is necessary for them to be able to determine or make decision around which segment is performing and which segment is not performing. And this standard is here to guide us on how to prepare this segment information. It will guide us on how to prepare this segment information. The first thing I need you to note is this. This standard does not apply to so a lot of organizations usually have branches, they have segments. Is it all of them that can apply standard? No, it's not all of them. So this standard is only applicable for entities that are listed on the stock exchange or are in the process of listing its shares on the stock exchange. So meaning that if you are not a listed company, you don't have to apply this. We don't need you to apply all of those. Additionally, if an entity has subsidiaries that it now prepares consolidated financial statement or group account. So when you're preparing or applying this standard, the segment information that you give us should be provided on the basis of the group account of the consolidated financial statement, not on your separate account. That's if you're a listed company. That's by introduction. Now, what is now an operating segment? When we say operating segment, what do we mean? IFRS 8 says that operating segment is a component of an entity that engages in business activities which may earn revenue and incur expenditures. Two, whose operating results are regularly reviewed by a CODM, who is called a Chief Operating Decision Maker, who is a person that allocates resources to each segment, and at the end of the year, assess their performance. And thirdly, for whom discrete financial information is provided. Okay. So an operating segment is a component of an entity that engages in business activities which may earn revenue and incur expenditures, whose operating results are regularly reviewed by a chief operating decision maker. And you see, this chief operating decision maker is not like a person or a position or something like that. It's not a position. We don't expect your company to have a position called CODM. No. Whoever is that person in your organization that allocate resources to segments and also assess their performance. That's the CODM. Whether it's the MD, whether it's the GM, whether it's the whoever in your company that does this, that's the CODM. And for whom discrete financial information is provided, meaning they provide operating results, P&L statement, and all of those statements for that particular entity, then that is an operating segment. There's something you might want to miss out here, which may earn revenue. So a company can have different branches. Each of those branches can be an operating segment, and they can also have a cost center, like an head office, or a research and development unit that does not make revenue. Can those ones qualify as an operating segment? Yes, they can, in as much as they are engaging in business activity. They might not make money, but without them, other units will not make money. Without them, the company will not operate efficiently. So like a research and development center of an organization can be an operating segment even though it does not earn revenue, but it's carrying out business activities. If it's carrying out business activities, then it can be seen as an operating segment, except if it is not carrying out any business, like the HR department of an organization. If your head office comprises of HR, accounting department, all of those ones that are just running as internal unit of the organization that does not impact on the revenue of the company, and they themselves don't make money. No, those ones are not operating segment because they are not carrying out business activities. They are just incidental. They are just assisting the other major segments. Those other ones that without them, we cannot function. Without them, we will not be able to make more money. Those ones are actually operating segment. Now, having understood what an operating segment is, then we can then move on to reportable segments. Reportable segments. So it is on the basis of a reportable segment that we will prepare segment information. And a reportable segment, this is an operating segment or an aggregation of operating segments that meets the quantitative threshold prescribed in IFRS 8, which is the standard. So if you look at this definition, we said a reportable segment it can be just an operating segment. It could be an aggregation of operating segments that meets the quantitative threshold. The quantitative threshold prescribed in IFRS 8. Now, there are two things I need to break down here. Number one is that, okay, can we aggregate operating segments together? Yes, of course, because they said that a reportable segment can be an aggregation of operating segments. So that clearly shows that we can aggregate operating segments. Secondly, when you aggregate or you see them as one, they can only be a reportable segment if they meet quantitative threshold. That's the second question we need to answer. What is that quantitative threshold? So let's quickly settle those two one by one. First is aggregation of operating segments. The following criteria must be met before two or more operating segments can be aggregated. Number one, the segments have similar products or services, meaning the nature of their goods or services are similar. Number two, the class of customers of these segments are also similar. They service the same class of customers. Number three, the production process. The way they produce their goods are also similar. The distribution process of these segments are also what? They are also similar. And finally, the segments have similar regulatory environments. These are the 5 criteria that must be met before you can aggregate operating segment. So you can put them together and see them as one segment. Additionally, in addition to the above criteria, the operating segments must have similar economic characteristics before they can be aggregated. This means that This means that if the above criteria are met, if the above 5 criteria are met, 5 criteria are met, but the operating segment don't have similar economic characteristics, you cannot aggregate them. And when we say economic characteristics, you are talking about having similar productive performance or performance indicators. The two of them must either be profitable or the two of them must be a loss-making center. When you look at indicators like the inflation rates that they face, when you look at the exchange rate environment, when you look at even their financial indicators like their gross profit margin and the rest, this is the ultimate. Having similar, this one is even secondary, which is, they are also important. These 5 are important, but we expect that they should operate in the same environment. They should be aligned in terms of profitability, in terms of performance, in terms of the inflation, the risk and opportunity that they face as an organization. They have to be aligned. So they need to have similar economic characteristics first. If their economic characteristics is dissimilar, you cannot aggregate. You cannot aggregate. Now, that's aggregation. Now, the second, we said whether you have an operating segment or you have aggregation of operating segments, before they can be said to be a reportable segment, they have to meet some quantitative threshold. And what is that quantitative threshold? Number 1, the operating segment revenue must be at least 10% of the total segment revenue. The operating segment revenue must be at least, meaning we expect it to be at least 10% of the total segment revenue. That particular segment, when you look at the revenue, it should be at least 10% of the total operating segment that you have in this company. Then that one is a reportable segment. If it is only this quantitative threshold it meets, it is a reportable segment. Meaning go ahead and present segment information on that. Number 2, the operating segment profit or loss is 10% or more of the greater between the absolute amount, or let me say between the total profits of all segments that does not report a loss and the total loss of all segments that does not make profit. So the operating segment profit or loss is 10% or more of the greater between the total profit and the total loss. You see when I solve a question for you. So this second point is just looking at, okay, what's the total profit? What's the total loss? So you separate total profit of all segment that does not report a loss, total loss of all profits that does not make a profit and does not make profit. You separate the higher between the total loss and total profit. The higher between them. When you pick the higher, so we are saying the operating segment profit or loss should be at least 10% of that. It should be 10% or more of that. You'll see. And finally, the operating segment assets should be 10% or more of the total segment assets. They only need to meet just one of these. As soon as it meets one of these, then it is a reportable segment. Then you can go ahead and present segment information as you wish on such an operating segment. Additionally, where reportable segments have been identified, the total revenue of the reportable segments must be 75% or more of the total revenue of the entity. If it is less, the entity must identify additional reportable segments, even if they don't meet the quantitative threshold. Just go ahead and make them reportable segments. So you must identify, let me call it the next meaningful operating segment and make them reportable segments, even if they don't meet the quantitative threshold. It doesn't necessarily mean the next biggest operating segment, but the next meaningful operating segment. So when you have operating segments, or when you have identified reportable segments, they need to, by the time you add all the revenue of those reportable segments together, it should be 75% or more of the entity's revenue. If it is less, you need to identify the next meaningful operating segment and make that a reportable segment, even if it does not meet the quantitative threshold, just so that the total reportable segment revenue is 75% or more of our total revenue. If you look at this question, they said after the aggregation criteria have been applied to its operating segment, an entity has the following segments. So it has operating segment A. So the segment revenue is 40. The total revenue of the company, including inter-segment sales, is 500. The segment loss is 10. The total segment loss of loss-making segment is 90. The total segment profit of profit-making segment is 200. Can operating segment A qualify as a reportable segment? Simple. We just need to check the quantitative threshold. First, we do the revenue test. We'll check, is his revenue up to 10%? What's his revenue? Is 40. What's the total segment revenue? Is 500. What's 40 divided by 500? 40 divided by 500. That's 8%. So for this one, fail. We'll check, they didn't give us the assets yet. Let's do profit or loss tests. So first, you will get the total segment loss is 90. The total segment profit is 200. You pick the higher first. The higher between these two is 200. Then you then do the segment loss is 10 divided by the higher between loss and profit of total segment. The higher is 200. What is 10 over 200? 10 divided by 200. That's 5%. What is this? Fail. The operating segment A cannot qualify as a reportable segment because it does not pass the revenue and profit tests. What I needed to be very watchful about is this when doing this profit or loss tests. Because we picked first, I looked at the higher. It doesn't matter whether it's Whether the segment makes a profit or a loss, it doesn't matter. We don't care about that, whether loss or profit. We will look at the higher, we will group all the losses together. What's the total segment loss? What's the total segment profit? Which one is higher? In this case, it's the total segment profit that is higher, 200. Even though the segment itself made a loss, we still did 10 over 200 to do the profit test, and it failed because less than 10%. So this operating segment A cannot qualify as a reportable segment because it does not pass the revenue and profit test. So it won't qualify. The question 2 says an operating segment has the following financial data: the segment revenue, total revenue, segment profits, total profits, segment assets, total assets. Can it qualify? I will do the revenue test or revenue criteria. The operating segment revenue is 50. The total segment revenue is 600. What's 50 divided by 600? That's 8.33%. I will also do my profit tests. In this case, I was not given any loss, so I will do 5 over 60. What's 5 over 60? That's how much? That's also 8.33%. Finally, I'll check for assets tests. The segment asset is 200 divided by 400. So what's 200 divided by 400? That's 50%. So pass. Here, fail. Here, failed. So from the above, the operating segment qualifies as a reportable segment because it passed the assets test. So even you can see that even though it only passed the assets, it still qualified. So it only needs to pass one, just one of it, not everything, just one of it. As soon as it passes just one of it, that's all. It is a reportable segment. You can go ahead and present and prepare segment information on that particular segment. So it is a reportable segment. Another one. Let me push. This says that entity A has the following operating segments. Entity A has the following operating segments. And I say the revenue, internal and external, profit and assets are set out below. Entity A needs to determine how many reportable segments it has. So give us plenty segments and total revenue, profit, asset, and all of that. Now say which of the following operating segments is reportable segments. So let's start from operating segment A. First, I do the revenue test. Revenue test. In fact, the best way I think I can do it I will do the revenue test. For segment A, I will do 11,000. And let me just say 11 since there are 3 zeros. Divided by the total revenue, which is 30.5. 30.5. So what's 11 divided by 30.5? That's 36%. So it passed. This one automatically is a reportable segment. You just need to pass one. So I don't need to check asset test for these other guys anymore. This particular segment A, because it has passed revenue test. So it's a reportable segment. So let me do asset test for segment B. That would be 7.5 divided by 30.5. So if I do 7.5 divided by 30.5, that gives me 24.5% pass. This one also is a reportable segment. Segment C, this will be 3 divided by 30.5. So 3 divided by 30.5. Wow, almost. That's 9.8%. Fail. So we can't see whether it's a reportable segment. This one for C, we still need to check profit or loss test and asset test.
So we cannot approximate.
No, don't approximate. Don't approximate. Segment D, this will be 3.5 divided by 30.5. What's 3.5 divided by 30.5? That's 11.5% pass. Reportable segments. Segment E. This is 4 divided by 30.5. 4 divided by 30.5. That gives us 13.11%. Pass reportable segment F. This will be 1.5 divided by 30.5. So 1.5 divided by 30.5. That gives us 4.9% fail. So from the revenue tests, only segment C and segment F needs to be checked further. So let's do profit or loss tests for those two. I don't need to do for every other one because you only need to pass just one of them. So let me just do profit or loss tests. First for segment C. Now for segment C, he made a loss, which is 1,000. Divided by, what's the greater between the total loss and total profit? From here, the total profit is 2,000. There's profit of 2,000. There's profit of 1,000, making 3,000. There's profit of 600 and there's profit of 400. That's already 4 million. And the losses is just this 1,500,000. So the total loss is 1,500,000. So the total loss is 1,500,000. The total profit is 4 million. The greater is 4 million. So we're going to be comparing against 4 million. So 1 divided by 4 million, that's 25%. So pass. Reportable segments. Now, segment F. Segment F has 400,000. It has 400,000 as its own profit. So we have already established the greater to be this 4,000. I think this is exactly 10%. Yeah, 10%. Pass reportable segment. So they are all reportable segments, though they passed under different criteria. And that's how you would check for this in this question. Now, this one is talking about an entity that has identified 3 reportable segments.
Hello, sir.
Yes, Christopher.
So, as it is now, may I understand very clearly? If a question like this is given, that means if you've gotten a pass on a particular segment, you should not go further for other calculations. Is that how it is?
Yes, it's not necessary again.
Or can you use okay in examination condition?
Yes, it is.
And
It's okay.
okay.
And the reason why it's
Will I
okay,
get something?
the reason why it is okay is because the standard requires you to meet just one of them. So as soon as you
Okay.
identify that one of them, it's 10% already, then what's the point of doing the others?
Okay.
So that's why
Okay.
it's okay.
And with after the calculations, you can just make you need to do any a little note on it. I will just
Yes,
end these calculations.
you can do a note on it that following from our calculation, segment A, B, D, and E are reportable segments based on the revenue tests, and segment C and F are reportable segments based on the profit or loss test.
Okay, you specify it that way.
Yes. There's a past question we'll solve. There's this question that they asked in May 2021 that they asked us to calculate all of this. So we will use that to explain it. We'll use that to explain what you're asking, but we'll get there. So, I was talking about this company. So they have 3 reportable segments, and by the time they looked at the revenue of those 3 segments, they saw that it's only 68% of the total revenue of the company. That means that they need to look for one additional segment. So the entity system provides for reports to be made to the CODM on 5 other activities that are reported to the system. That means, yes, we have identified 3 as reportable, but they have 5 operating segments. So meaning that they still have two two that they can look out for. They now said none of these 5 activities individually large enough to constitute a reportable segment. Oh, meaning that in addition to these 3 they have an extra 5 that are operating segment. They now say that none of them is large enough to be considered as reportable. So they now said the largest among them has 8% of the total segment revenue. So what we are saying, what I was explaining that time is that based on this standard, we are going to designate this particular segment that has 8%. When you compare its revenue to the total revenue, we are going to make it a reportable segment. So therefore, that means the total revenue of the entire reportable segment will then increase from 68%. By the time you add 8%, it goes all the way up to 76%. That means it has already crossed the 75% threshold. So all the remaining operating segments that are not reportable, we will usually put them under all other segments category when we are preparing our segment information. So we'll have reportable segments. We can have 5 reportable segments. In this case, they have like 4. The remaining 4, they will just put all their figures together and call them all other segments. All other segments. And everything ends there. So on Wednesday, I will solve these 2 past questions with you. And there are some questions here that you can look at before Wednesday that would serve as an eye-opener for you to understand operating segment more. And also we'll look at how segment information looks like by considering some disclosure requirements on IFRS 8. Then we would end it up with IFRS 8. Then we would quickly look at another short standard, which is IAS 34 on interim financial reports. It's a very, very short standard that should not pose any challenge to us. Now, when we are now done with that, we have very little to cover. Then we'll then start looking at group account. And for more indication, we'll be able to solve a lot of past questions because now you have learned a lot of standards. But the principles of group account itself, I should be able to finish teaching you that within maybe, if we meet 1, 2, 3, maybe like 5 times or 6 times, we should be able to finish up 5 times maximum. We should finish up the principles. Then the remaining time, we would then spend those quality time to solve past questions. Then when we are successfully done with that, then I will take out ratio and EPS, which are also particularly extremely important. Then sustainability reporting. Those ones will come out. You will definitely see that one in your exam. That one is sure. And of course, they will ask you the roadmap for sustainability reporting in Nigeria, because a lot of companies are not really adopting, but FRCN, Financial Reporting Council of Nigeria, already issued a roadmap on adoption. ICAN will definitely ask you this diet. So we're going to be doing, those will be our focus for October. So we have very little things to, so hopefully we'll still have time to be solving past questions, but what we have left is nothing compared to what we have actually covered here. Now, none of you is reminding me, there are 2 things we left that I said we will come back to, which we haven't. Number 1 is the deferred tax implication of share-based payments. when I was teaching you share-based payment, I said we'll come back to share-based payment. So go and revise share-based payments. So that when I'm teaching you the deferred tax, everything will not look like, because it's been a while we taught it. So it's important you revise it so that you can easily follow along. Also, I also left equity or cash settled share-based payment. I said when I teach you compound financial instruments, we'll come back at that. So go and revise that also, because I will be going back to it very soon. Thank you for today. We'll share you these notes, then we would be seeing tomorrow. Don't forget, we still have like 2 more classes for our Sunday classes. Tomorrow we are going to be looking at IFRS 5, non-current asset held for sale, and possibly IS 40, investment property. If you have time to cover the two, but if you are unable to cover the two, we will stop whenever we can, or wherever we get to, we just stop. Okay, thank you. See you tomorrow.
Hello, sir.
Yeah, Mr. Christopher.
The only complaint I'm having is the delay for the upload of the class. That is the only issue I'm having. I don't know whether you can be making it earlier enough.
Once we don't delay now, a day.
So sometimes it's after like 2 days before you bring it up.
Yeah, that is not too much now. Have you
It's
read all
too,
the
it's too much. Sometimes
example?
after the class, I go through immediately to get a better understanding of what I'm trying
I
to
get what
fight
you're
for.
saying. Yeah,
Mm.
I get what you're saying. Maybe
I
we'll
go through
reduce
immediately.
it down to a day. Maybe we would upload it the same day.
Better, please, sir. That'll be fine by
Okay.
us.
No problem. We would try to do that. Like today's class now, we'll upload it today, and the other one as well.
So that when you go through immediately, you get it more. You get it more than waiting for like 2 days later. Other
I agree.
activities will not take. Thank you
I
so
agree
much.
with
We're
you.
obliged with that. Thank you.
All right, no problem. Thank you very much. Bye.